Hello and welcome to the programme. Joining me in the studio today is Eimear Daly of the London-based foreign exchange company Monex Europe. Ms Daly, thanks for joining us today. Now we're looking at Australia and the Australian dollar. Some analysts have told me that the Aussie dollar really needs the US yield spike to stop and partially reverse before investors will come back with a more bullish approach to the currency. Do you agree?
Yeah, I have to say I do agree. I think always in terms of the Australian dollar, interest rate differentials have been so critical to its valuation. This was mainly because the Australian dollar and Australian assets was really one of those carry trade currencies. It really benefited because they had those higher yields. But now with the US beginning to rein back in monetary policy and even looking to tighten it, we could see the interest rate differential really narrow, and the Aussie dollar will definitely lose out on this.
Now, we recently saw the Aussie dollar drop to a 5-week low against the US dollar after a disappointing business confidence data release. Is that the only reason for the drop?
I think what was interesting was even the day after we had that NAB consumer confidence release, we had the Westpac consumer confidence release. That actually showed an uptick in confidence, which really shows there's more downside scope to the Aussie dollar, and really shows it's not just that particular indicator which was leading the Aussie lower. We've seen more and more evidence that the Australian economy really isn't doing that well. The mining investment boom is really cresting, and what's becoming more apparent is that the non-mining business investment isn't picking up. We've also seen employment continuing to fall, higher employment rates, and really that's impacting consumer spending.
Now, you said to me prior to this interview that you thought the Reserve Bank of Australia is banking on the possible housing bubble to provide the economy with some support. But as we've seen from property-dependent regions such as the United Kingdom, for instance, it isn't healthy to rely solely on your housing market for a means to prop up the economy.
No, not at all. They definitely don't want to get into the regions where they have a property bubble, and that's dependent on household leverages. And the RBA have noted this in previous policy statements that what they don't want is consumers being over leveraged. However, they've looked at the risk and they don't seem all that concerned about it in the short term. I think really the reality is there's nothing else to really prop up the Australian economy. We've got tighter fiscal policy coming through. We've got a peak mining investment boom, and even though they've cut the interest rate by 225 basis points since 2011, the other sectors of the economy just really aren't responsive. So RBA has to depend on the only sector, which is the housing boom, which is really starting to pick up just to support the economy through this downturn.
So we know the Aussie dollar is too high for comfort right now. The RBA are sounding dovish. When are you expecting to see a rate cut?
I'd say definitely into the second half of next year, probably in the second quarter. I think to an extent the RBA are going to wait and see what happens in monetary policy in the US. If the Fed does tighten, and what effect that will actually have on the Aussie dollar. Obviously, they always want the Aussie dollar lower. That will provide them with some support. But I think it won't be enough to really boost their economy. So they will have to cut again in the second quarter.
Okay, that's all for now from me here on Dukascopy TV. We have exclusive interviews on Russia and the UK today, as well as our regular Targets in Focus programme. So do go and check those out on our homepage. But for now, goodbye.